big US companies with a high dividend yield. I asked you what kind of video you want to see, and here we are. There are a few things that I personally like about big US companies. One of them is that they have a proven track record in certain areas, such as doing business of course, but also in paying dividends. They know how it works out there. In this video I'm going to show a list of 6 stocks that I think are one of the more interesting big US companies with a high dividend yield. I'm very excited to see what you guys think about these stocks, so please let me know your thoughts in the comments. And if you think a company is missing in this list, please let me know as well. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. First stock on this list is Merck & Co. Ticker symbol MRK. Merck is one of the bigger healthcare companies out there and they have been around for a long time. Market cap is at 233 billion and they have a PE ratio of 16.5, which could indicate they are also undervalued. 12 trailing month revenue is at 53.9 billion and it's going up and down quite a bit, so definitely keep an eye on this number. Profit margin is at 26%, which is very nice, especially since it's above the 5-year average profit margin, meaning margins are increasing. Free cash flow is also going up and down quite a lot, so keep an eye on this number as well, since free cash flow is used to pay down debt, buy back shares and pay dividends. And buying back shares is very important from a dividend perspective, so let's check out what's going on there. In the past decade, Merck bought back a lot of shares, which is very nice, since this makes it more easier to maintain and increase the dividend, since less total dividends are paid. So this looks very good to me. But keep an eye on this number because since 2021 it's stagnating. Next up are the dividends. Right now dividend yield is at 2.99%, which is very nice. Annual payout is at $2.76 a share or 69 cents a quarter. Payout ratio is at only 37%, meaning there is 63% left in cash to buy back shares and pay down debt. The 5-year growth rate is sitting at 8.8% and they grew the dividends for 12 years in a row. Overall, this dividend scorecard looks good to me. Dividend yield is very attractive compared to the payout ratio. My final conclusion on this stock is that we need to do a bit more research before we buy. But dividends are looking really great. Not sure if it's a value play as well. And to be honest, with the dividend growth rate sitting at 8.8%, I don't think this is a dividend growth stock. So for me, it's more of a defensive dividend play, which could be very nice to have. Next stock on this list is Abbvie, the only stock in this list that's currently in my portfolio. Abbvie is also a healthcare company, and again, one of the bigger companies in the US. Abbvie has a 264 billion market cap with a PE ratio of 21, which could indicate that they are around their fair value. The 12 trailing month revenue is at 56 billion and is going up quite a bit during the pandemic. So make sure to keep this in mind. Profit margin is at 22%, which is above the 5-year average, so this looks very good to me. Free cash flow is growing quite a lot in the past years, and to me this is very important since free cash flow is used to pay down debt, buy back shares and pay dividends of course. And the thing I don't like about Abbvie is the fact that they issue more shares in the most recent periods, meaning you get diluted as an investor. This also means that total dividends paid is going up, which isn't a good thing from a dividend perspective. But to be honest, dividends are looking really great on this scorecard. Right now, dividend yield is at 3.77%, which is very high. Annual payout is at $5.64 a share or $1.41 each quarter. Payout ratio is at almost 42%, which is slightly below my maximum of 50%. As soon as it is 50% payout ratio, I think you should be very careful. So definitely keep an eye on this number, especially since shares outstanding are increasing. The 5-year growth rate is sitting at 17.5%, which is very high, and they grew the dividends for 9 years in a row, which is also very nice. My conclusion is that I think that Abbvie could be a great dividend growth stock. It has a great dividend scorecard and most fundamentals are looking great as well. But the shares outstanding is something that I really don't like right now. Third company on this list is Broadcom, ticker symbol AVGO. They have a big focus on tech products, which makes it very interesting from a dividend perspective, since most big tech companies are paying a lower dividend yield. Market cap is at 207 billion and they have a PE ratio of 23, which could indicate that they are near their fair value. 12 trailing month revenue is at almost 30 billion and it has really skyrocketed since 2014. and it's still going up quite a lot. Profit margin is at 29.8% and higher than the 5-year average of 25.7%, meaning margins are increasing, so that's also very nice. Free cash flow is going up quite a lot, so that's very nice, since this is used to pay down debt, buy back shares and of course pay dividends. So this looks really good to me. A thing that I don't like about this company is that they issue a lot of new shares since 2016. In the most recent periods, things seem to cool down, but definitely keep an eye on this number, because issuing more shares makes it more difficult to pay dividends and of course growing them. Dividend yield is at 3.34%, which is really high for a tech company, as I told earlier. Annual payout is at $16.4 a share or $4.1 each quarter. Payout ratio is at almost 50%, which is the maximum to me, so keep an eye on this number. But guys, please, check out the 5-year growth rate. Almost 35%, which is insane. This is why people love Broadcom. On top of that, they grew the dividends for 11 years in a row. Final conclusion, I really like this stock, but there are some things which I don't like, of course. So I will make a full analysis very soon. But from a dividend perspective, things are looking really good. Next stock on this list is UPS stock, the world's largest parcel delivery company, so that makes them one of the larger US companies as well, of course. 12 trailing month revenue is at 98 billion, and please take a look at the revenue growth. Since e-commerce is really booming, UPS is growing in almost the same way, so that's really nice. Profit margin is at almost 11% and significantly higher than the 5-year average. So again, margins are increasing, which is a good thing, of course. Free cash flow isn't really consistent, so that's something I don't like about this company. But since 2019, it's kinda consistent, so keep an eye on this number, since free cash flow is used to pay down debt, buy back shares and pay dividends, of course. And to me, shares outstanding is something that I don't like as well. Since 2018, they increased the shares outstanding, which isn't a good thing from a dividends perspective, since total dividends paid or payout ratio is going up. So keep an eye on this number as well. You want the shares outstanding to decrease. Dividend yield is at 3.38%, which is very high. Annual payout is at $6.08 a share or $1.52 each quarter. Payout ratio is looking really good at 36.9%. Meaning they have roughly 63% left in cash to pay down debt, buy back shares. The 5-year growth rate is at almost 10% and they grew the dividends for 22 years in a row. Overall, this looks really good to me. Final conclusion is that I think UPS could be an interesting stock to add to your portfolio. E-commerce is booming, and with UPS being the market leader, I think they will definitely grow in revenue in the coming years. From a dividend perspective, things are looking really good, except for the shares outstanding. Next stock on this list is Verizon stock, ticker symbol VZ. They are the largest US wireless carrier and they serve around 93 million postpaid and 24 million prepaid phone customers. Verizon has a 211 billion market cap, with a PE ratio of only 9.89, which could indicate that this company is undervalued. The 12 trailing month revenue is at 134 billion and it's going up and down quite a bit, so keep an eye on this number, especially since margins are decreasing. Right now, profit margin is at 15.9, while the 5-year average is at 16.2. Free cash flow is also going up and down quite a bit, and I would prefer a bit more consistent pattern here. But okay, since 2016 it's going up, so that's the good part. And to me, it's very important that free cash flow is growing, since this is used to pay down debt, buy back shares and pay dividends. And since shares outstanding are increasing a little bit in the past years, I do think this is something to dive in deeper. Since increasing shares outstanding means total dividends paid will go up as well, which is something you don't want as a dividend investor. So definitely keep an eye on this number. And now the part that most people love about Verizon stock. Dividend yield is at 5%, which is really high. Annual payout is at $2.56 a share or $0.64 each quarter. Payout ratio is at 46% and the 5-year growth rate is at 2%, which is very low to be honest. But with the dividend yield already sitting at 5%, I don't really mind about the growth rate. They grew the dividends for 18 years in a row, which is very impressive. My final conclusion on the stock is that depending on your goal, this could be an interesting investment. Although I don't like the shares outstanding, the dividend yield is insane compared to the payout ratio. And now the last stock on this list, which is Cisco stock, ticker symbol CSCO, which is one of the largest hardware and software supplier within the network solutions sector. Cisco has a 181 billion market cap with a PE ratio of 15, which could indicate that this stock is undervalued. 12 trailing month revenue is at 51 billion and it's going up and down quite a bit. The good part is that profit margin is significantly higher than the 5-year average, which is something I really like, of course. Current profit margin is at 23%, which is very nice. Free cash flow is also growing very nice and steady, so this looks really good to me, although it's decreasing a little bit in the most recent years. So keep an eye on this number, since free cash flow is used to pay down debt, buy back shares and pay dividends, of course. And the shares outstanding is something that I really like about Cisco. They are buying back a lot of shares, which adds a lot of value to the investor. From a dividend perspective, it's also really nice since total dividends paid is going down. Right now, dividend yield is at 3.57%, which is very high. The annual payout is at $1.52 a share or $0.38 each quarter. Payout ratio is at 44%, which seems to be okay, since you want to keep payout ratio below 50%. The 5-year growth rate is at 6.4%, which isn't a lot, but at least it's growing, and they grew the dividends for 11 years in a row. My final conclusion on Cisco is that I really start liking this company. Business seems great and they have great fundamentals. On top of that, you get a juicy 3.5% dividend yield, which is very nice. And the thing that I like the most are the decreasing shares outstanding. So, this was the full list on big US companies with a high dividend yield. To be honest, all companies seem to have a great dividend scorecard in a way, but not all fundamentals look that great. So please remember to always do your own research and never fully trust what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insight of the companies to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.